Hey guys, this video will look at how interest rates can help achieve the government's economic goal of full employment. Now, as we know, full employment is part of the three-part goals of domestic economic stability. So we've already looked at how interest rates or monetary policy can help achieve strong and sustainable economic growth, and we talked about how the primary goal of monetary policy is to achieve low inflation. So under that assumption that the primary goal of monetary policy is to achieve low inflation, we're going to assume that low inflation is already achieved, and then once this is achieved, the government or the RBA would then start looking at achieving this goal of full employment. And to remind ourselves of this goal of full employment, this is when everyone who wants a job can find one. So what this means is there is no cyclical unemployment due to low or insufficient aggregate demand. So with this in mind, and full employment being the rate of unemployment where there is no cyclical unemployment, there is only structural or natural unemployment, we're going to look at how monetary policy can actually help increase aggregate demand so there is no cyclical unemployment due to low aggregate demand. So we're going to look at aggregate demand as being what we've looked at throughout this series of economic lectures, as being C plus I plus G plus net exports, also X minus M. Yeah, so we've talked about how using monetary policy, especially expansionary monetary policy, the RBA can manipulate the monetary base and therefore the money supply in the economy to change the prevailing level of cash rate in the overnight money markets, and therefore that would change or spill over into other financial markets. So that would hence decrease interest rates in the entire economy. And we're going to see how a decrease in interest rates would actually affect each of these components in aggregate demand. So firstly, let's look at consumption. When consumption decreases, or when consumption increases due to a decrease in interest rates, is due to a greater number of large purchases because, and this is the symbol for because of lower cost of credit. So when interest rates decrease, that means the people or consumers would have to pay a lower rate of credit or a lower rate of return on borrowing money. So if they wanted to buy a house, that means interest repayments on their mortgage would in fact be lower than previously at a higher rate of interest. So therefore consumption expenditure, especially on long-term or high cost goods, would increase, and that would affect consumption by actually increasing consumption. I'm just going to do an upwards arrow to signify that consumption expenditure by households would increase. Using the same analogy or using the same logic, investment expenditure by firms would also increase because the cost of borrowing credit would decrease, and therefore firms would be more likely or have greater incentive to purchase property, plant, and equipment in order to expand their supply potential. Thirdly, we can see how net exports would actually improve, is that a decrease in interest rates would actually affect net exports by increasing our exports and decreasing our imports, because interest rates, as we know, can affect the exchange rate of the economy. And because it affects the exchange rate, that would make net exports relatively more competitive in the international market, and imports relatively less competitive. So what this means is because a lower rate of interest would actually result in a lower dollar, that would mean our exports becomes more competitive, and imports, or to purchase things from overseas, would then become more expensive. So as an overall consequence, aggregate demand in the economy would increase. So aggregate demand would increase. So we're going to look at how this would in turn affect unemployment. So we're going to look at this in terms of the two-sector or the five-sector flow model. So households and government. So we're not going to worry. So households and businesses. We're not going to worry about the government, the financial or the overseas sector. We're just going to worry about the households and business sector. So the first flow is from households to businesses, and that is the provision of labor. Provision of labor or resources to businesses. And when those businesses receive labor, flow 2 would be to pay income to households for their labor resource. This is the flow of income, is the second flow. Thirdly, once the households receive income, that will result in the fourth flow. And this the third flow would actually encompass all the other sectors, so financial, government, and overseas, and this is actually the flow of consumption. Or, in other words, aggregate demand. And finally, the last flow is this flow is the flow of final goods. Final goods and services. So when the households consume using aggregate demand, then the businesses would therefore give households the goods and services that they have paid for. Okay. Let's actually rewrite that to make it a little bit clearer. Sorry guys. Final goods and services, and this being the final flow. So what happens now is that we've seen that interest rates or decrease in interest rates using monetary policy would actually increase aggregate demand overall, and through consumption, investment, and net exports. We're not going to worry about the government sector for the minute, but we can see that the overall effect on aggregate demand is that aggregate demand increases. And so when aggregate demand increases here, this would mean that the demand for final goods and services would actually increase. So final goods and services from businesses to households would increase. And as a result, this would mean that businesses need greater amounts of labor here in order to produce these goods and services to meet the requirements of these households. So as a result, the provision of labor or the demand for labor increases. So we've assumed under this assumption is that the economy is not at full employment at the moment, and therefore there is what we call as cyclical unemployment. And that's the reason behind why monetary policy is conducted, in order to move the economy back to this full employment state. So there is excess labor or labor resources available in the economy for the businesses to hire, and as a result we can see that when consumption increases, aggregate demand, the provision of final goods and services increases. As a final consequence, the demand for labor increases. And when the demand for labor increases due to this increase in aggregate demand here, we say that cyclical unemployment decreases. So that's how monetary policy can help the government achieve its economic goal of full employment, by decreasing interest rates once low inflation